What's been happening in the market? And more importantly, what does that mean for you? Welcome to LVZ Market Minutes, the quick and refined update designed for savvy investors who value clarity over clamor. Our team breaks down the trends, movers, and the headlines that matter so you can stay informed and cut through the noise. Let's dive in. Past performance does not determine future results. Securities offered through Harbor Investments, Inc., member FINRA SIPC. Investment advisory services offered through LVZ Inc. LVZ Inc. is a federally registered investment advisor.
Everything has its place, Joey. That is absolutely true. June, July, and August all have their place. A lot of important things transpired. Certainly not necessarily in the market in the last month. It's been pretty quiet. Just as a recap, in June, we hit an all-time high in the S&P 500 in the markets. Not much has transpired coming off of a strong earnings season. Joey, give us a recap of what we saw in the month of July.
It's been really pretty uneventful. It's been a good month. If you'll remember, last time we recorded, the market had just hit an all-time high in the S&P 500 last night, with a day of recording being July 25th. So yesterday, the S&P 500 hit another all-time high close. It's chugging along really well. There's nothing, honestly, too significant headline-y. It's just been going along with the market. A lot of the headlines and the talking points are more policy-related, politics. And it's nice to see a separation from policy conversation and market reaction. It's nice to see that the market just keeps going.
It's certainly been an eventful summer for anyone involved in tax strategy and planning. So today we have a special guest, Josh Franken, CPA and Financial Planner here at LVZ. And Josh is here to help us break down the biggest headline of the summer, the one big, beautiful bill that everyone has on their lips and is putting education together around. Josh, we're excited to dig into this and how it impacts all clients. So there's really something in here for everyone. And we'll dive into that. And of course, if there will be residual impacts related to some of this in the market with Joey. So like I said, there's something in this bill for every tax filer. There's something in this bill to benefit a myriad of ages. So we're going to walk through this in the ages and stages of life. To start with our seasoned adults, Josh, walk us through some of the key implication for someone who's maybe in the 55 or 65 and up bracket.
Well, first, thanks for having me. The first thing for some of those seasoned adults that are out there, one is the Social Security deduction. Originally, they were trying to get Social Security income removed from your income, just in general, but they determined that that was not a reasonable thing to do. And so instead, they replaced it with a deduction that you get. If you're a single filer, it's going to be $6,000 to remove from your Social Security income on your tax return. And if you are married filing jointly, it's going to be a $12,000 deduction on your tax return.
Okay, awesome. That sounds like it'll be a great benefit for a lot of people.
This tax bill will cover a lot of different individuals. It's not just those in the lower bracket. It's not just those benefiting those in the higher tax brackets. It's really across the board going to be a good thing, I think. The second thing for seasoned taxpayers is going to be the estate tax exemptions. Prior to this bill going into place, it would have reverted back to the pre-2018 rules, which would have been a $7 million estate tax exemption for single filers, and that's $14 million for married filing jointly. It has now increased to $15 million for single filers and $30 million for married filing jointly. So that is a very big increase that will include a lot of additional taxpayers when it comes time to assess what their estate is worth once they pass away. And that's really the only time that this will come into play is when you pass away, what is your estate worth? And if it's worth less than those amounts, then you will not have to pay the estate tax.
What an incredible benefit.
Yep, it's really great.
As someone who's not yet a seasoned adult, or I wouldn't consider myself one, it sounds like it's something that people should be proactive about making sure that is set up so by the time that they do get to that stage in their life that things are well-oiled to be most advantageous after they pass away for their family and their friends that they want to leave behind as beneficiaries as well. Talk to me as we trickle down into our mid stage of life range. We've got, of course, some tax rate changes. Let's talk a bit about what those are and how that impacts our current taxpayers.
The tax rates became permanent from what they were in the last few years. And so there actually have been no changes made, which is kind of a change in and of itself because they were going to revert back to a different tax rate. The lowest tax bracket is going to be at 10%. The highest tax bracket is at 37%. And then there's an array of different brackets in the middle there. What is tricky from a tax planning standpoint is that for a lot of people, there's a bracket that ends, it's the 12% bracket that ends at about $97,000 of taxable income. And once you get past that, it jumps up to 22%. There's a lot of tax planning strategies that we try to implement because going from 12 to 22, that's a pretty big jump. It would have been great if there was some sort of in-between tax rate, but that's just not the case here. And so we just have to be very aware of that as we're doing some of that tax planning, that we're either staying within that 12% bracket or just dipping our toe into the 22% bracket if it is required of Roth conversions or, charitable giving.
Sure. So you mentioned charitable giving. There is something in the bill related to charitable deductions. Talk to me about what that charitable deduction changes.
It's important to know that this will take place beginning in 2026. So this isn't something that will apply to this tax year, but Congress did put a provision in place that says single filers can deduct up to $1,000 of charitable giving, and married filing jointly can deduct up to $2,000 of charitable giving, even if you take the standard deduction. So charitable giving in the past and still currently is a part of itemized deductions. And so if you have enough itemized deductions for that to work, then charitable giving has been able to be a part of that. But if you've been taking the standard deduction, you don't get a tax break for those deductions or for those donations, which I hope that the tax breaks aren't the reason why people do the charitable giving, but it does certainly increase the appeal of doing it for people. Being able to deduct a little bit of that, I think, will be beneficial. But as far as administration is concerned, the taxpayers are going to want to keep track of their giving receipts now up to that $2,000, where in the past, a lot of people have been conditioned to be like, well, it's not going to matter anyway, so why do I need to keep them? Now it's going to be like, all right, if I get something from church or if I get something from the mission or something, that I gave to, you're going to want to hold on to those up to that $2,000 amount.
That's a really important reminder, especially with all these changes coming as a taxpayer. Having books and records of all of your itemizations is critical, especially when you're working with someone like a CPA and a financial planner to design a very tactical plan to optimize all of these opportunities. As far as the impact on SALT, so I've seen that acronym. I know what it means. Give us a little education around that and the changes that are coming related to SALT.
SALT is an acronym for state and local taxes. In most cases, this would apply to state income taxes that you pay maybe through your paycheck. It will include property taxes that you pay on your property, registration fees on your vehicles. In some cases, sales tax. If you're in a high sales tax state, that will often apply. In the past, the deduction for these things, and again, this goes back to the itemized deduction. So if you were a standard deduction taker, this didn't matter at all. But if you were taking an itemized deduction, you could only receive a benefit for up to $10,000 in taxes that you paid across those items. So property taxes, state income taxes, registration fees, things like that. That has now increased to $40,000. And so if you have a vacation home and your own home, okay, maybe your property taxes have ballooned to more than $10,000, you will now be able to take up to $40,000. It's a little bit less of an impact in a state like Michigan, where property taxes aren't terribly high and where state income taxes aren't terribly high. And so the big benefit came to higher tax states like New Jersey, California, New York, and so forth. But just with the tax returns that I've seen in the past, there are still a lot of people that do get limited by that $10,000 cap. Now going up to 40 is going to be, I think, beneficial for a lot of people.
That's awesome.
Yeah, I guess I was just curious how common of a breaking point from not needing to needing and it being worth using this SALT deduction up to $40,000. Is that going to be something that a lot of people should be considering? Or if it's not most people, who are the people that it's like, if you've got this scenario, this is what you need to be looking for?
Mm-hmm. And again, that just boils down to the itemized deduction versus the standard deduction, okay? Because the standard deduction is at $31,500 for 2025. And so if you don't have medical expenses, state income taxes, mortgage interest, charitable giving above and beyond that $31,500 in any particular year, this isn't going to benefit you.
Yep.
Right. And so if you do have those things, if you are very charitably inclined, or you have several properties that you own personally and use for personal use, or, make a significant amount of wages that would then include state income taxes, then that's where you need to be considering this.
Gotcha.
But again, you have to consider all of those items as to whether or not this SALT deduction is going to apply to you, or if you're just going to stick with a standard deduction.
Right. Okay.
And that's the benefit of not only marrying the investment management financial planning piece with an integral plan that makes sense for your scenario, but the tax planning piece as well. Every scenario looks completely different, and there could be multiple factors that a tax planning software that someone's just hopping into may not catch. Working with an advisor and CPA, having eyes on it and understanding these changes and what's coming down the road. Like you said, not all of it's coming this year, some of it's coming in 2026. And understanding how to best set yourself up for success related to this is critical. So impact for small business owners, this one is quite considerable. So the qualified business income, tell me about those changes, Josh. We specialize in helping small to mid-sized business owners here at LVZ, and I like to say small to mid-sized businesses are the backbone of America. So this has some significant impact. Walk us through what the QBI changes are.
So again, this is one of those things where if Congress hadn't done anything, if they just would have let the Tax Cuts and Jobs Act provisions expire at the end of 2025, it would have been a change back to what we had pre-2018. But because they made the move, we're able to make permanent what they had in place, so that for taxpayers moving forward, it's not a change, which is, again, a good thing, because everybody, I think, would prefer not to have those changes to deal with and just kind of have the status quo. Just a brief background on how this happened. In 2017, with the Tax Cuts and Jobs Act, they lowered the corporate tax rate for C corporations. So think the likes of publicly traded companies that are C corps. And they lowered it to a point where it's in the, low 20% range. Well, if you have a small business, so think partnerships and S corps, which make up the lion's share of businesses across the United States, those are flow-through entities. And so the income from those goes to the individual's tax return and gets taxed at their personal rate, which, like we just talked about, can go up to 37%. So that puts them at a very large disadvantage from these bigger corporations. What the act put in place was this qualified business income deduction that says businesses that are in that smaller area, so S corps and partnerships, and sole proprietors as well. So if you have a Schedule C, this will apply to you. You are allowed to take a 20% deduction in most cases against your business income, which will hopefully level the playing field more so with those bigger corporations. And without this change that Congress passed, you would have just reverted back to what happened before, and your business income would have been subject to the higher personal income tax rates. But now, with being able to shave off 20% of your taxable business income, that, like I said, levels the playing field a little bit more with bigger companies.
I know that there's a lot of small to mid-sized business owners that are rejoicing for some permanence in tax planning. I think that makes everyone's job easier.
And the fact that this happened in July and not on December 15, right. I think just allows a lot more clarity. And even from an IRS standpoint, it will allow them to sort through what was passed in the next months, so that by the end of the year, we should have a pretty good idea of what things look like. Things have been clarified, so it's good.
So moving into our impact for the youngest generation in America, we've got the Trump account. Those details are specifically for children born in 2025. So this account is meant to essentially long-term invest in the future of the American economy. Walk us through those details and give us some information about the Trump account.
So these Trump accounts, I think the intent of them is to help the younger generation get a jump start on investing, see if you can get them involved a little bit more so that they're just accustomed to it as they reach adulthood. It's like, all right, I've already got this account. I need to know a little bit more about it, and that will hopefully launch them quicker into investing in Roth IRAs, traditional IRAs, your 401k at work, things like that. So I think it's good to raise awareness for this generation as they reach adulthood. But as far as the specifics are concerned, for those children as of right now born between 2025 and 2028, they would receive $1,000 from the government that would go into this specific account. It's going to be treated like an IRA. The money that is in it will grow tax deferred, which is a good thing. The parents can contribute money to it. And so the total contribution each year into these accounts can be up to $5,000.
Are those contributions tax deductible?
They are. Yep. So they would be excluded from your taxable income. If you are an employer and you want to put that in for an employee's kids, that's allowed. If you're just a parent and you want to kind of do it off on the side and do it for your kids, that's allowed. The tax implications of this, because the IRS, they always need their piece of the pie at some point. They're not just going to allow the government to give you a free $1,000 or allow you to put money into this and not ever pay taxes on the gains. If you take it out for qualified purposes after the child has reached the age of 18, it will be taxed at capital gains rates, which are more advantageous than just ordinary income rates.
Mm-hmm.
If you take it out for non-qualified purposes, then it would be taxed at ordinary income tax rates. There's a lot in this thing that still needs to be figured out. And that's why the IRS now, they're tasked with trying to sort through what Congress put in place and, okay, how are we going to implement all this? And so a lot of the details are still a little fuzzy and will become more clear as time goes on. But it is a way to start putting more money into the markets and grow it in the private sector, which I also think is good as apart from like the Social Security system. This is something that you can control as a taxpayer. You're putting the money in, you're betting on the United States, the economy here in the U.S. to grow this. I think going to be a good thing. It's just a matter of we'll have to see how it gets implemented and what the rules look like.
And there's no guarantee. I mean, past performance does not determine future
Exactly.
results, right? So it's something that's meant to build long-term over time. And we talk about long-term investing and strategies quite a bit. That's our philosophy, is that you're staying in the market, you're staying invested, and not being worried about short-term impacts and market movements on the daily basis. That's a lot packed in that bill. That's a lot for our gamut of taxpayers. Our full array of clients certainly has a lot of implications to sort through for 2025 and looking ahead to 2026. As far as anything else that people should be looking for as they're headed into their 2025 season filings, is there anything you want to give as advice for filers upcoming?
Like I said, a lot of this is they're not really changes. They're just things that have been in place and have now been made permanent. And so there's not a ton that needs to be tracked any differently than what was done before. If you're still used to providing property tax information and your charitable giving, please still do that because it may be more applicable now. But in those cases where you're not used to it, there are a couple things where you're going to want to keep track of the property tax bills. You're going to want to keep track of the charitable giving that you do because it could make a bigger impact this year. But just know that this bill that passed, it was a big deal. And so whether you do your tax filing on your own, or if you have those of us at LVZ do it, or if you have a tax preparer that does it, they will be on top of this sort of thing. And so they should be well equipped to come to you and say, hey, what about this? What about this? What about this? So that the taxpayer doesn't have to be the expert on it. That's what you have us here for, to keep tabs on that, because this is what we like to do, surprisingly. Bring it on, we'll help you navigate it.
To be equipped with the information this far ahead of a tax season is really helpful. I know our team has already dug into the nuts and bolts of what does that mean for our clients? What does that mean for our portfolios? What does that mean for the markets? Joey, what are some of the implications for this related to the market? So suddenly you're having the youngest Americans beginning investments in the market over a long period of time. How do you see that trickling down in the next 10, 20, even 30 years?
It could go so many different ways, and it all depends on how pessimistic or optimistic you want to be. You could look at it to a certain extent if you give an entire population of something that, at minimum, if it grows, could be a couple $1,000s per person. That could be inflationary, where every person in the population at 30 has an artificially accumulated amount of money. That could be inflationary. You could look at it as incredible education, because people are going to learn from a young age the power of compounding investments. So there's so much with it. I think it's a net positive. I think it's probably good to be aware of all the ins and outs of it. Education, that's where working with someone like Josh is super important, because he's got an understanding of all the ins and outs of these type of programs, and that often you may get a very simplified promotional version of it in a headline, but there's a lot of little things going on. To your point, the government is rarely going to do something where they can't get a little piece of it back. So at the very least, being aware of what does a tax bill for an 18-year-old liquidating some of this amount for college look like if they have no other income and then all of a sudden they've got a tax bill. That's something to be aware of. There's so many avenues to look into, but I'm excited for the concept.
What are some things that we are keeping on our radar from a portfolio standpoint in the markets?
Continuing to be aware of the market conditions. If you'll remember, earlier in the year, we had talked about how towards the end of 2024, there was pretty high valuations, PE ratio for the S&P 500. Those numbers went down a lot because of the sell-off in the market, but they've come back up to where they were, which is where people were kind of concerned, saying, oh, this is pretty high valuations. It could be a little expensive. Be aware. Similar topics to where we were earlier in the year. Just being aware that we don't want to chase performance. We don't want to chase shiny things. Looking for good, fundamentally quality investments and doing what we feel and have researched as to be the best interest of our clients.
Locally here in the summer, it seems like in Michigan, the summer season is high real estate transaction season. We've certainly seen that perceptively, at least from my end, with for sale signs slow quite a bit, and with the Fed holding tight to their rates for the summer and won't meet again until September. Is there any impact to that related to markets that we're seeing with rates holding?
There's a lot of economic indicators that seem sort of tied up with the rates. A lot of the home building, the housing market transactions seems pretty slow, pretty log jammed, and we're waiting for a change in the landscape there. But we haven't gotten clear indication that that's happening in the near future. Continuing to wait and see what the Fed does and then dealing with the market as it is until that point.
And of course, with ongoing tariff negotiations, as businesses begin to see those implications impact their bottom lines in the next quarter, it'll certainly be interesting to see how the Fed responds with rate adjustments moving from there as those start to create actual impact in businesses.
With anything that comes from the government, so for example, this bill, there's going to be positives, there'll be negatives, and working with someone who has tax experience, finding a CPA, working with your advisor, is going to help you maximize what is good in it and minimize what is bad. Look for experts who can help you out with something like that, especially when it is a pretty significant change, or at least a maintaining of what could have changed in the tax structure.
That speaks to our team approach here. If you're not working with a team of professionals or experts in a specific area together cohesively, that makes all the difference, right? Having every expertise perspective present really builds the most resilient plan, the most optimized plan. And that's how we take an approach with our investment committee in our portfolios and in our financial planning here at LVZ. Gentlemen, thanks both for your time today, for your expertise. Josh, thanks for digging into the One Big Beautiful Bill and helping us digest that from your CPA perspective. We'll look forward to what comes next month and building further tax plans for clients as we head into 2025.
That concludes this month's LVZ Market Minutes. Quick, clear, and curated to keep you informed and empowered. If you found these insights valuable, be certain to tune in each month for a strategic update. Until then, stay informed, stay invested, and have peace of mind that our team is actively monitoring the markets and managing your portfolios.